Okay, part 2 of chapter 4. So the next step is to prepare a post-closing trial balance. So all it is just like we did in chapter 2, we had a trial balance. This is just listing the accounts that still have balances after closing. So post-closing, what accounts have a balance and do the debits and the credits equal? So it's going to list all of our what would be permanent accounts and their balances after we post those closing entries. Again, the same as before when we did chapter 2 with the trial balance, we want the debits and the credits to equal. So here's what it's going to look like. The post-closing trial balance has our assets, cash down to equipment, a contra asset, accumulated depreciation. It has our two liabilities, payables, and then our unearned liability. And then it has our capital account. We've closed out the revenue, we've closed out withdrawals, and we've closed out the expenses. So they're no longer on here because their balances are zero. So now we're just going to see the permanent accounts and list their balances. Once we do that, we're going to add to make sure that our debits equal our credits, and we can see that they do so that we know that we're ready to move on to the next step. All right, so just to summarize the steps in the accounting cycle, we've done most of them now. In chapter 1, we analyzed transactions where we looked at what happened in that transaction and what accounts would increase or decrease. In chapter 2, we learned to journalize them into our journal entry, the formal entry where we have our debit and our credit. We also learned in chapter 2 to post them to our T accounts or the general ledger. Then we learned how to do the trial balance, which turned into what we call the unadjusted trial balance. So step 4 is the unadjusted trial balance. Then in chapter 3, we learned how to do adjusting entries. So we adjusted and then we post their balances. And then we were able to prepare step number 6 where it says the adjusted trial balance. So we took our adjustments that we did and adjusted our balances from that unadjusted into that final column. From there, we were able to prepare our financial statements. After we do that, we want to close it for the period to recognize that we're closing our temporary accounts. And then we prepare our post-closing trial balance. So that's our last step here. Step 10 that they list here is in the appendix. It's reversing entries, which we don't go into in accounting 1. That's more of an intermediate accounting kind of situation. But steps 1 through 9 are what we are going to see in our accounting cycle on a regular basis. All right, so before we've talked about a balance sheet, and it has been what we would technically call an unclassified balance sheet. But now we're going to learn how to classify them. And all we're doing is putting the categories that we've talked about into the process in the balance sheet. So we talked before about current assets and current liabilities. And we said that current in accounting means that it's within 1 year. So if we expect to collect it within 1 year or we expect to pay it within 1 year, that would be our current assets or our current liabilities. So typically when we're looking at that, we're breaking it down into what is our current asset and what is our long-term or non-current. So under assets, the non-current would be our long-term investments, so investments that we're going to have for more than 1 year. Our plant assets, like our equipment, our building, things we're going to have for more than 1 year. And then intangibles. So we talked about a little bit of them when we went through the chart of accounts. We talked about intangible assets being like a copyright or a trademark, those things you can't physically touch, but they have a value for longer than 1 year. And then on the liability and equity side, we're going to have current liabilities and non-current liabilities. So our current liabilities are going to be the liabilities that are going to be paid within 1 year, but we also are going to have long-term liability or non-current, and that means that it goes longer than 1 year. So for example, a mortgage, you don't typically pay a mortgage off within 1 year, so it's a long-term liability. So it's going to be listed separately. All we're doing now is we're breaking down the balance sheet into different categories. So here's what a classified balance sheet is going to look like. So before we just had all of our assets listed and a total and our liabilities and our equity. Now we're just breaking it down into current assets, long-term investments, and then plant assets. And then you see the other intangible, which we won't see a lot of in our examples until we get to chapter 10. But just to make you aware that this is how the format changes. We just break it down into different categories. It's still assets, and then we have the same thing for liabilities. We have our current liabilities, and then we have the long-term liabilities. And then equity didn't change. All right, so let's talk about what some of those accounts are just so we can make sure we're familiar with them. So current assets are the ones that we expect to be sold, collected, or used within 1 year or one operating cycle. Long-term investments are the ones that we are going to hold on to for more than 1 year. Plant assets are the tangible, long-lived assets that we use to either produce or sell our products. So it should be equipment, machinery, it could be a vehicle, it could be a building, land. Those kind of things are plant assets. We're going to hold on to them for a long period of time. Intangible assets are long-term assets that are used to produce or sell products and services, but they don't have a physical form. So again, the copyright, the trademark, those kind of things are going to be our intangible assets. Current liabilities are liabilities that are due within 1 year. So if we have to pay it within 1 year, which most liabilities we're going to have to, but we do have those, we might have a note that we get to pay over a longer period of time, or a mortgage. But a lot of our liabilities, like our accounts payable, typically our customers are going to want us to pay within 30 to 60 days. They're not waiting more than a year. So that's why they will always be current. Long-term liabilities are the ones that are longer. So our mortgage, we're gonna have a short-term portion of that long-term liability. So we have during that year, the amount that's due on the mortgage, that amount is current. But the part that's due after a year would be our long-term liability. For equity, that doesn't change, still the claim on the owner's assets. Nothing changed in equity with the new format. And then the last part of the chapter takes us into our ratio. So the ratio we're going to learn in chapter 4 is called the current ratio. And the way that we calculate it is we are going to take our current assets divided by current liabilities. And when we're doing that, it's going to be able to tell us, with the amount of assets we have, can we pay the current liabilities that are coming up? So we might have enough inventory to cover our liabilities, but what if we don't sell that inventory? So we want to look at those current assets that are the things that we're going to have for a short period of time, like our cash. Do we have enough cash that we can pay the current liabilities that are coming due within that 1 year time period? If not, we have to figure out how are we going to solve that issue? Like, what are we going to do to come up with the cash to pay the things that are coming up due in the next year? So this ratio being, if this ratio is off, then that would tell us that we could be in trouble, that we may not be able to cover those current liabilities as they come due. All right, so that takes us through the lecture part of chapter 4. The next thing we're going to look at is the chapter 4 practice. So we're going to do the practice A by video, and we'll go from there. I'll see you on the practice side.